I'm your host, Peter Resnicek from ShadowTrader.net, and this is the Weekend Edition. Another month is behind us, so that means we are definitely going to look at some monthly charts for the end of June. NVIDIA seems to be tiring itself out a little bit, and that is ushering in the dynamic that I've been speaking about in these shows for the last 2 weeks, which is that there is a great rotation going on out of technology into some of the other 10 S&P sectors rather than an all-out crash scenario, all right? But before we get into all that, let's check out the state of the S&P and NASDAQ right now and see what the charts are telling us so we can know exactly what's really going on. Not that much change this week from a technical perspective. If you recall from prior shows, we've been talking a lot about the 8-period moving average exponential on the daily, both in the futures and in the cash market, and we really haven't budged off of that level very much, and we spent most of the week in balance, creating a larger balance area that was in play, and actually, for the most part, continues to be in play. We're going to get into that a little bit later in the show in order to show you how you can actually profit from the nuances of these balance areas. But before we get into that, let's shift over here for a second and look at the S&P just on a daily so we can see how many days we've been interacting with this 8-period moving average. I'm just going to kind of box off this area, which is off of the last 5 sessions or so, and you can see that the green dotted line right here is the 8 EMA, and notice that even though almost all of these sessions interacted with that 8, none of them actually closed below the 8. And the close really matters more than anything else. The close of a bar, no matter what the time frame is the most important piece of information about that bar. More important than the open, the high, or the low. It's all about the close. And you can see that none of these bars closed below the 8. Just today, on Friday, the 28th, we closed below the 8 just by a hair. And what's also noteworthy is that this is a cash chart, S&P. It's not a futures chart, but if you recall from prior shows, I did say that the market had made an overnight high in the futures market, right? When it started to come off, there was an overnight high left up there, and I said we will revisit this overnight high more than likely because there are higher odds of it happening rather than not. Highs made in an overnight session generally don't end the auction. And this is an important point because this high today on Friday was made in an RTH session. That means that the futures actually went higher between 9:30 and 4 p.m. than they did before that in the overnight session. And that high is a little bit more secure. So I'm going to carry that forward in my narrative as well as something slightly more bearish, but not really. But in general, we do still need to see this market close a daily bar below the 8. I think the odds favor that a bit going into next week for a couple of reasons, mainly just because of how many interactions we've had thus far. It's relatively rare for a market to sort of ride a moving average like this and be testing 1, 2, 3, 4, 5, 4 out of those 5 sessions testing and then not have a daily close below it. So if so, we're probably looking at a target here to the 21 EMA, which right now is about 54.10-ish. In the cash, that's going to move up a little next week as time goes on, but we shall see. Overall, as I've been saying, I am just seeing a very rotational market. I am not really seeing an all-out crash situation or any larger move lower. It feels to me like it will be a grind for some time, and we're going to get into that a little bit deeper as this show goes on. Let's shift gears for a second. We're going to change symbol and we're going to change time frame. So this is NASDAQ 100, and I want to talk about weekly here just because I don't want to leave you hanging on what we talked about last week when we talked about that inverted hammer on the weeklies and what the potential was for that to follow through to the downside. And I think that this further illustrates what I've been talking about, that there is really not a catalyst currently in this market for stronger selling. If anything, this is the type of action that we're going to get for a little while until another catalyst comes in. So look at the weekly bars here on the NDX. Now we've got back-to-back hammers with the top tails, but again, how much follow through did we get to the downside? I would say almost none, right? This was the bar in question that we talked about in last week's show, saying, okay, we've got a tail. On a longer term time frame, such as a weekly, I do pay attention to the tails. I was saying I don't really care about the tails on dailies, hourlies, or anything sub that. I'm really more interested in weekly and monthly. We got the tail, and what happened this week? We went higher, got another tail, went a little bit below that low, which I'm sure was a short trigger for some technical traders who are trading on the weekly time frame. But where did we close? Pretty much unchanged of the week. It's pretty much just sideways right there. So even this index, which is so much more heavily weighted towards technology, even this NASDAQ 100 is just not catching a lot of selling right now. And again, this is what I expect to continue for a little while longer. Since it's the end of the month, as I was saying at the open of the show, we do need to look at monthlies. We like to look at these once the monthly bars close. Instead of changing the symbol, I thought we'd just start on the NDX since that's the chart we were on before. Pretty strong bar. I mean, the only thing that could be a little bit concerning is you notice you do have a channel here and you're kind of right up against the end of that channel. The high was just over the 20,000 level this week, which is a psychological, right? A big round number, basically a psychological number. I guess the NDX wanted to tag that 20,000, went a little bit above it and backed off. But just be aware that you can ride the top of a channel like this on the monthlies for some time. Look at what was happening here, right? We had 4 straight months where we banged up against the top of the channel and we didn't come down. So I'm just saying that, you know, each thing is a data point, and each data point also has to be in context of how that data point acted prior to that, right? So don't get too tied up on just the channel. But basically, bottom line is monthly chart is bullish, expansion of range to the upside. Monthlies are a little bit tricky in that because they encompass such a long period of time, there can be swift reversals early in the month, and you can have big candles like this not follow through, right? You can easily have monthly bars that are pointing in one direction as that month closes and then, you know, completely reverse or do something unexpected afterwards. So just keep that in mind. And last but not least, in the charting portion of our program, S&P monthly, not a whole lot to say. I mean, it's going to look very similar to the NDX, just basically that you have a big body candle. And high right now is 5523.64 this week. Mark that off as your high, carry that forward in your narrative. But overall, not a whole lot to talk about on this monthly, other than, as I was saying in the NDX, you do have an expansion of range to the upside. Usually means that you'll have some continuation off of that strong bar. But again, with the monthlies, caveat is, doesn't necessarily have to happen that way. But if you were trading on just this time frame and you were making decisions just on the monthly bars, I would say it would have to be a hold for you, right? If you were a long only player and you're looking at monthlies, there's nothing here that screams sell at this very moment. Moving on to our lead story of the show, which is that the market may simply not be the best for trading for the next 2 weeks to a month or so from this juncture. And I'm going to go through a couple of things that to me point to that. But before we get into that, and this is especially for newer traders out there, you must understand that there are 3 biases, right? Not just 2. There's not just, I think it's up or I think it's down. There is always door number 3, which is that I think it has a high propensity to be sideways. And this is very, very important because that sideways action in the broad market is going to wreak havoc on the trades that you are trying to put on, which may be more directionally biased, right? If you're thinking it's got to be up. Basically, there are trades in the market that either need the market to do something specific, and I'm going to touch upon that a little later, this is very important, need the market to do something specific or do not need the market to do something specific, right? So you could be an options player, you can be a strictly credit collector, right, where you just sell premium. In that case, you do not need the market to do something very specific. However, if you are more of a debit player and you may be purchasing verticals, wide butterflies, whatever, you need the market to do something. So for me, the MO right now is I want to be involved in as little as possible types of trades where I need the market to do something over the next few weeks because I don't think the market is going to do very much at all, okay? That being said, what are the catalysts that I think are actually going to get this market moving? I think the first one is going to be the earnings, which is the Q2 earnings season that's going to kick off in July. This is obviously not a very complete list, but if you look at the names that I chose here, it's a lot of the Magnificent Seven, Fangman plus T. I threw Goldman Sachs in there because they're very, very important. GS is really oftentimes a bellwether for the market. And notice what the dates are here. We don't kick off any of these big names until mid-July, so at least 2 weeks from now. And notice that it stretches out July 23rd, Google, Meta the 24th, Microsoft at the end of next month, Amazon, Apple, NVIDIA, Broadcom, none of that is happening until August. So from an earnings perspective, if the Q2 earnings are to be the catalyst to get the market moving a bit again and stop the sideways malaise, these are the dates you want to be thinking about, and just understand that this is not kicking in for a little while longer, all right? Beyond the earnings, let's talk about FOMC for a second. This is going to be important, but it's going to be a little bit later, and this is where I think the larger catalyst is going to occur at some point late summer, early fall. This graphic right here is from the CME group, and these are the Fed funds futures odds basically that they put out according to how the Fed funds futures are trading. What are the odds of a cut or remaining the same? We know that the current target rate for interest rates by the Fed right now is 5.25 to 5.5, which is right here. These are the target rate probabilities for the next meeting, which is July 31st. So think about that for a second. You have an entire month until the next meeting. And within that meeting, currently the odds are 89.7% that the Fed holds pat, that there will not be any policy change and will stay at the 5.25. And if you notice here, there's only a 10.3% chance that we are going to tick down 25 basis and reset the target rate at 5 to 5.25. So that's important. Again, and the operative thing to understand here, July 31st is this meeting. So you've got a whole month before this. Let's move on to the next slide for a second. This one here is the target rate probabilities for September. And this is where I think the market is going to sort of wake up a little bit, and it's probably going to start to happen ahead of this meeting. But notice the date. This is not happening until September 18th. And here, which is for the first time in a very long time, is where the probabilities finally start to shift, where the current target rate here of 5.25 is only about a third chance, 34.1% chance that we stay where we are now. And look at how much it's increased now that we start to cut. 5 to 5.25, almost 60%. So here's where I think things start to get interesting. So as we move along over the next, say, 4 to 6 weeks, I want you to keep these three graphics in mind that I just showed you, that you're not even close yet to the Q2 earnings. That's going to start to ramp in mid-July, into the end of July, into August. And again, that Fed is not going to do anything until September. And here, even here, it's not a guaranteed deal. I mean, you were talking about a 60% probability that they do something. But again, this is not happening until much later either. So again, you put all this together, I think there's somewhat of a lack of catalyst to get equities moving right now for the time being. I thought we'd spend just a short amount of time on market profile this week, only because something really interesting happened on Friday, which is today, that illustrates not only how well the market profile works, how powerful it is, how much I believe that everybody should have this in their arsenal as part of their daily routine, right? But also beyond that, it also speaks very, very clearly to everything we're talking about in this video and the last couple of videos, which is the nature of this rotational market. So let's look at this slide here of the market profile. I thought it would be more effective if we looked at it together like this as a snapshot as opposed to the profile itself. But basically all I've done here is I've just boxed off the earlier part of the week, and that's what's known as a balance area. So what it does is it sets up something called the balance rules. And the balance rules tell us that the market, when it's in balance, meaning that it has highs and lows that are equal, you've got horizontal resistance and horizontal support, as we saw here in the confines of the yellow box, everything essentially before Friday. The balance rules tell us that the outcomes are very finite. So you don't know exactly what is going to happen, but at least you have a framework of different scenarios of what is potentially going to happen. So you are A, not surprised when it does happen, and B, you are ready to act on a moment's notice when it does happen. So the balance rules basically are very simple, telling us that the market can either, one, look above and go, meaning it'll break out of that balance area to the upside and keep going. It can look above and fail, whereupon if it does so, the target is the opposing end of balance all the way down, or it can do the same things on the downside. It can look below and go, or look below and fail, whereupon the target is the other side, or it can just remain in balance. So obviously that third one is not what happened today. You can see that we actually looked above and went early on and then failed, right? This is the Friday action today. We did a look above and fail, whereupon it set up the move that would be the rotation to the low end of balance. This picture was taken before that actually happened right in here, right? But notice that this was actually my trade. If you can see this clearly, short the ES at 53.30 and cover 20 points lower at 55.11. Why is that? Because if you look closely here, this low is poor. That means that it was not an end of an auction that should happen. That auction the day before on Thursday did not end properly, so it needed that excess low. And if you were paying attention on Friday, later in the afternoon, you noticed that as we were hanging around the 55.30, we did get that big move down, which was, for me, able to cover that short about 20 points lower right there. And why was I doing that? Like I said, a couple of reasons. I knew that the framework here was in play for me to rotate all the way to the low end of balance. And then beyond that, that 55.30 made sense to me to be short there because I knew that that low needed to be repaired. And in this case, it worked very well. If you recall what happened on Friday, we slammed down to this low end of balance. So we went to about 55.10.75. And this is the part where I want you to carry this forward and take it into your narrative as part of your longer term analysis. And it's the fact that, yes, we made the rotation. We had the look above and fail. ES came down to the balance area low, but where did we close on Friday, right? We closed back up around here, around the 55.30. So the market is obviously speaking to us loud and clear that the longer time frames that should be in play, meaning the ones that are looking for that loss of the 8-period moving average, the EMA that we talked about, the ones that are looking for bigger signals like that, it doesn't feel to me like they are in the market. So either you have mostly short-term money in this market, and or you have a lack of conviction in terms of direction because of the rotational nature of the market. It can be either of those two things. I think it's a little bit of both, right? I think you're going to get less institutional players as we're into the summer months, and they're going to pick up their activity more towards the fall. But more importantly, that great rotation we've been talking about, if the money is only coming, say, out of technology a little bit, but it's going straight into healthcare, straight into communications, into financials, consumer discretionary, consumer staples, etc., then it's going to be very difficult for the ES and the NQ or whatever, mostly the ES we're talking about, to sort of crash through levels and keep going. Okay, so this I really just wanted to show you so that it really drives the point home of how rotational this market is. But within that rotation, obviously on a day time frame basis, you know, I'm not a futures trader every day, but when I see things like this, it's like I just got to do it because it just seems so dead obvious, right? I sort of wait for an opportunity where the money is just lying in the corner and all I have to do is walk over and pick it up. And to me on Friday, this made perfect sense to me, where I just needed to pick up the money in the corner because of the look above and fail down here, back into range. And then when I saw, oh, look, this low is poor from the prior day, that structure needs to be repaired. So what's going to happen? It's going to repair that structure and it's going to complete the bigger pattern of the rotation to the balance area low, all right? And going forward, where does that leave us? Obviously, this is your key support, right? That 55.10 area in the ES is the area that you need to carry forward for next week. That ties in with those moving averages we talked about on the daily. And obviously, only there would I expect that stronger sellers would emerge in this market if they see a breach of that level. Normally about this time in the program, I leave you with the #1 draft pick, but I don't have that this week because honestly, I could not find even one individual stock, at least not in my particular universe, which is relatively limited, that I liked enough to present as a trade idea. So instead, I'm going to leave you with the alert of the week, which from this week comes from the Weekly Options Advisory, and it is something that I said to my subscribers on Monday the 24th at 12:52 p.m. and I specifically wanted to put this into the program because it really encapsulates my thinking of everything I've been saying over the last couple of weeks about this market. So to recap here, I said I believe the current state of rotation out of technology will last for some time. The market has a strong potential to be sideways to down until about mid to late August. The market should rally, accent on should rally ahead of the potential rate cut in September, after which I would not rule out that the actual cut is sold if it comes. So meaning a little bit up into that potential cut and then selling on the cut. The play for now is to trade much lighter, very important, unless we see conditions majorly change. And that was what I wrote much earlier this week on Monday, and that is what we've been doing ever since. We really don't have a lot of debit exposure, if you will, on trades. If you recall, at the beginning part of this program, I said something that I really wanted everybody to take to heart and take home with you, and that is that There are always two types of trades, especially in the options market. Trades that you need the market to do something specific in order for that trade to work, and trades where you do not need the market to do anything very specific in order for that trade to work. So, right, so the latter could be a play on time, like a theta play where you're just selling some premium, could be a play on volatility, things like that. These are instances where you don't need the market to do anything very specific, and that's my MO right now. I'm more in trades where I don't need the market to do anything specific in order for me to win, and that has been working very well for us over the last couple of weeks. And when these conditions change again, then I believe it's time to get a little bit more aggressive, lay out more debit, be more directional, etc. once those conditions change. And that's our show for this week. Kind of short and sweet. I want to just quickly remind everybody, hit that like and subscribe button and also the bell to be notified when we post videos such as this one, and also our shadow shorts, which myself and my team put out every single evening. And if you just sign up on the homepage of ShadowTrader.net, you can get those. A lot of those are coming from our team in the live trading suite. You know, we have 2 rooms now. We split it up. We've got a stocks and options room and a futures room. And I'm very excited to tell you that next week I'm going to have an interview with Scott Schneider, who is one of the futures traders in the new room. And we're going to be talking about some of his techniques and his edge and how he approaches the futures market. He's been doing a great job over there ever since we started that. So I'm very excited to have him. So check that out next week. All right. Markets. Relatively sideways. Most important takeaway from this entire video, I think, is simply that sideways is a bias. Remember that. The market is sometimes up, the market is sometimes down, the market is sometimes sideways, and those periods where it is sideways, if you can sidestep those periods as much as you can, because those are the periods where you're going to get chopped out, at the end of the year, you will see that your P&L will thank you for it. All right? Remember, you can always take a $7 1-week trial to any of our rooms. You can check that out at our site. Next week is a shortened week, which we've had a couple of those shortened weeks recently, and next week is another one because Thursday is the 4th of July and markets are closed in the afternoon on Wednesday. It will be a shortened session, and New York Stock Exchange will close at 1 p.m. on Wednesday. So we'll have a shortened trading week, so keep that in mind as well. All right, coming at you from beautiful and sunny Los Angeles, California. As always, I wish you good trading and good night.